Have you ever opened your mailbox, pulled out what looked like just another government letter, and almost tossed it aside without a second thought? What if that one envelope contained information that could affect the amount of money you receive every month for the rest of your retirement? If you were born before 1961, this is something you need to pay attention to. Right now, millions of Americans are receiving updated Social Security notices. For some people, they're already sitting unopened on the kitchen counter. For others, they're still on the way. But whether you've already received yours or you're still waiting, what it says could influence some of the biggest financial decisions you'll make in retirement. The problem is that most people glance at these notices, assume nothing has changed, and file them away without realizing they're missing information that could cost them hundreds of dollars every single month. Today, we're going to change that. Over the next few minutes, I'll walk you through exactly what's changing in 2026, why so many people born before 1961 are suddenly hearing about these updates, what the latest Social Security adjustments really mean, and most importantly, what steps you should take right now to make sure you're not leaving money on the table. Some of these changes have been decades in the making, others took effect this year, and a few are being widely misunderstood online, creating unnecessary confusion and fear. By the end of this video, you'll know which changes actually matter, which headlines you can safely ignore, and how to check your own benefits using official information instead of rumors circulating on social media. So stay with me, because one small decision about when you claim your benefits could mean the difference between receiving hundreds more or hundreds less every month for the rest of your life. Hello everyone, I'm Clara Maynes, and welcome back to the channel. If you're interested in straightforward updates about Social Security, Medicare, retirement planning, and the government programs that affect older Americans, you're in the right place. I spend countless hours reviewing official announcements, policy updates, and changes from the Social Security Administration, so you don't have to sort through confusing headlines or misleading information on your own. If that's the kind of content you find helpful, don't forget to subscribe and turn on notifications. That way, you'll know about important changes before deadlines arrive, not after they've already passed. Now, let's dive into today's topic. The first question many people are asking is simple. Why is everyone suddenly talking about people born before 1961? The answer actually begins more than 4 decades ago. Back in 1983, Congress approved one of the biggest Social Security reforms in American history. At the time, lawmakers were concerned about the long-term financial health of the program. Rather than making one dramatic change overnight, they created a gradual plan that would unfold over many years. One of the biggest parts of that reform involved increasing the full retirement age, often called FRA. For decades, Americans expected to receive their full Social Security retirement benefit at age 65. That had been the standard for generations, and many families built their retirement plans around that number. But the 1983 reforms slowly changed that expectation. Instead of raising the retirement age all at once, lawmakers increased it little by little, just a few months for each birth year. Because the changes happened so gradually, many people barely noticed. Life went on. People focused on raising families, building careers, paying mortgages, and planning for retirement years down the road. Meanwhile, the retirement age quietly continued moving higher. Fast forward to today, and that decades-long transition has finally reached its endpoint. If you were born in 1960, your full retirement age is now 67. If you were born in 1959, it's 66 years and 10 months. Those born in earlier years reached their full retirement age under the previous schedule, but the important point is this. The gradual increase that started more than 40 years ago is now complete. That makes 2026 an important year because many Social Security statements now reflect the fully phased-in retirement age alongside several other annual updates. That's why so many people are seeing new discussions online, receiving updated notices, or hearing friends talk about changes they weren't aware of before. But here's something that's often misunderstood. The letter arriving in your mailbox isn't announcing a brand new law. It's not telling you that your benefits have suddenly been cut. And it certainly doesn't mean Social Security is disappearing. Instead, it's providing updated information about your personal benefits, your payment amounts, and any adjustments that apply this year. Unfortunately, this is where misinformation spreads quickly. You may have seen dramatic headlines claiming that everyone over a certain age is losing benefits, or that retirement rules have suddenly changed overnight. Those headlines attract clicks, but they don't tell the whole story. The reality is much less dramatic, but far more useful. Most of the important changes for 2026 involve routine annual adjustments, including cost of living increases, updated earnings limits, Medicare premium changes, and confirmation of your benefit estimates based on your age and work history. Understanding those details can make a real difference when you're deciding when to claim benefits or checking whether your monthly payment is accurate. Before we go any further, let me ask you something. Do you know your exact full retirement age, not just the year, but the month? Many people don't. They know they're around retirement age, but they couldn't tell you the specific month when they're eligible to receive 100% of their earned benefit. That may seem like a small detail, but it's one of the most important numbers in your entire retirement plan. Claiming benefits even a few months earlier than your full retirement age can permanently reduce your monthly payment. On the other hand, delaying benefits beyond that point, if it makes financial sense for your situation, can significantly increase the amount you receive later. That's why understanding today's updates matters so much. Because before you make any decision about when to claim Social Security, you need to understand exactly how the current rules apply to you, not to your neighbor, not to a friend, and not to someone you saw talking about retirement online. And that's exactly where we're headed next. Let's walk through the 6 biggest Social Security changes for 2026 one at a time, starting with the adjustment that almost every beneficiary notices first: the annual cost of living adjustment, better known as COLA. Let's start with the change that affects nearly every Social Security recipient each year: the cost of living adjustment, or COLA. If you've been receiving Social Security benefits for a while, you've probably noticed that your monthly payment changes slightly from one year to the next. That's because the Social Security Administration adjusts benefits to help keep pace with inflation. For 2026, that adjustment is 2.8%. At first glance, 2.8% might not sound particularly exciting. In fact, some people hear that number and immediately think, that's not going to make much of a difference. But percentages don't always tell the whole story. For the average retired worker, that increase adds roughly $56 to the monthly benefit. Over the course of a year, that's several $100s that can help offset rising everyday expenses. Now, is it enough to completely cover higher grocery prices, utility bills, insurance premiums, or prescription costs? For many retirees, probably not. Everyone's spending is different. Some households have seen costs rise faster than inflation, while others have managed to keep expenses relatively stable. The important thing is understanding how COLA works instead of simply assuming the number was chosen at random. Each year, the Social Security Administration uses a government inflation measure known as the Consumer Price Index for urban wage earners and clerical workers, often shortened to CPI-W. Without getting buried in technical language, here's the simple version. Officials compare average prices during the third quarter of one year with the third quarter of the previous year. If prices increase, benefits generally increase as well. If inflation remains flat, benefits typically stay the same. And here's something many people don't realize. Since automatic COLA adjustments began in the 1970s, there have been years when inflation was so low that no increase was issued at all. But even during those years, monthly Social Security benefits did not decrease because of the COLA calculation. That's an important distinction, especially when rumors begin circulating online claiming that benefits are about to shrink because inflation has slowed. Now let's move to the second major update, one that directly affects people born before 1961. As we discussed earlier, the long phase-in of the full retirement age, has officially reached its final stage. For many Americans, age 65 still feels like the traditional retirement milestone. After all, that's the number many people grew up hearing from parents, relatives, and coworkers. But today's rules are different. If you were born in 1960, your full retirement age is now 67. That means claiming benefits before reaching that age results in a permanent reduction in your monthly payment. Notice the word permanent. This isn't a temporary penalty that disappears later. It's a lifelong adjustment based on the age you choose to begin receiving benefits. That's why knowing your exact full retirement age matters so much. Imagine someone who assumes they're already eligible for their full benefit because they've turned 66. If their actual full retirement age is still several months away, filing too early could reduce every future payment they receive. And once benefits begin, reversing that decision isn't always simple. This is exactly why your updated Social Security statement deserves more than a quick glance. It provides information that's specific to your work history and your birth year, not generic estimates that apply to everyone else. Now let's talk about another rule that catches many retirees by surprise. What happens if you continue working while collecting Social Security? This is where the annual earnings limit comes into play. If you're collecting retirement benefits before reaching your full retirement age and you're still earning income from work, there's a limit on how much you can earn before part of your benefit is temporarily withheld. For 2026, that annual earnings limit has increased to $24,480. If your wages exceed that amount before reaching full retirement age, Social Security generally withholds $1 in benefits for every $2 earned above the limit. The first time people hear this rule, many assume they're losing that money forever. Fortunately, that's not how it works. The withheld amount isn't a permanent loss. Instead, once you reach your full retirement age, the Social Security Administration recalculates your benefit to give you credit for those months when payments were withheld. In other words, the money isn't simply disappearing. It's being factored back into your future monthly benefit. There's another important detail. If 2026 is the year you actually reach your full retirement age, the earnings limit is much higher. Instead of the standard annual limit, you're allowed to earn up to $65,160 before the withholding formula applies. And even then, the reduction becomes much smaller, just $1 withheld for every $3 earned above the limit. Once you've officially reached your full retirement age, the earnings test disappears entirely. You can continue working, whether part-time or full-time, and earn as much as you want without reducing your Social Security retirement benefit. For many retirees, that's incredibly valuable information. Some people want to remain active in the workforce. Others enjoy consulting, seasonal employment, or running small businesses during retirement. Understanding when those earnings limits no longer apply can help you make smarter financial decisions. Now let's look at another change that's less noticeable but still important. The maximum amount of wages subject to Social Security payroll taxes has increased again. Each year, there's a cap on how much earned income is subject to Social Security taxes. As wages rise nationally, that cap usually increases as well. For workers with higher incomes, this means a larger portion of their earnings is subject to Social Security payroll taxes during the year. While nobody enjoys seeing more taxes withheld from a paycheck, those payroll contributions are one of the primary funding sources that support today's Social Security program. If you're already retired, this change probably won't affect your monthly benefit directly. But for people who are still working while approaching retirement, it's another reminder that Social Security rules continue evolving each year. So far, we've covered 4 important updates. But the next change is the one that surprises many retirees because it quietly reduces the amount of money that actually reaches their bank account. Let's talk about Medicare premiums and why many people feel like their COLA increase disappeared almost as quickly as it arrived. Now let's talk about something that catches many retirees off guard every January. You hear that Social Security benefits are increasing because of the annual cost of living adjustment, you expect to see a noticeably larger deposit in your bank account, and then the increase seems much smaller than you expected. So what happened? In many cases, the answer is Medicare. For most retirees, the standard Medicare Part B premium is automatically deducted from their Social Security benefit before the payment ever reaches their bank account. That means the amount you actually receive each month isn't simply your gross Social Security benefit. It's your benefit after certain deductions have already been taken out. When the Part B premium increases, it can absorb a significant portion of your annual COLA. Let's look at a simple example. Suppose your monthly Social Security benefit increases by about $56 because of the 2026 COLA. At first, that sounds encouraging. But if your Medicare Part B premium also increases by around $17 each month, your actual take-home increase becomes much smaller. Instead of feeling like you received the full adjustment announced in the headlines, you may only notice a fraction of it. That's why so many retirees say things like, "I got a raise on paper, but I barely noticed it." They're not imagining things. They're simply looking at the amount deposited into their bank account after Medicare premiums have already been deducted. This is exactly why reviewing your annual Social Security notice is so important. It doesn't just tell you your new benefit amount. It also explains how deductions like Medicare premiums affect your final monthly payment. Understanding both numbers, the gross benefit and the net deposit, helps eliminate a lot of unnecessary confusion. Now let's move to another topic that becomes increasingly important as retirement savings begin replacing employment income. Required minimum distributions, often called RMDs. If you've saved money in a traditional IRA or certain employer-sponsored retirement plans, you've probably heard this term before. Under the Secure 2.0 Act, the age at which many retirees must begin taking required minimum distributions increased to 73. At first glance, this may not seem directly connected to Social Security, but the two often interact in ways many people don't expect. Here's why. Money withdrawn from traditional retirement accounts counts as taxable income. And as your taxable income rises, it can affect how much of your Social Security benefit becomes subject to federal income tax. This surprises a lot of retirees. Many assume Social Security benefits are completely tax-free. In reality, whether your benefits are taxed depends on your overall income. One of the biggest reasons more retirees are paying taxes on their Social Security today is that the income thresholds used for these calculations have remained largely unchanged for decades. Meanwhile, wages, pensions, investment income, and retirement account balances have continued growing over time. As a result, more households cross those thresholds every year, even if they don't consider themselves wealthy. That doesn't necessarily mean you'll owe taxes, but it does mean it's worth understanding how withdrawals from retirement accounts can influence your overall tax picture. Now let's shift to something that deserves everyone's attention, regardless of age: scams. Unfortunately, criminals continue targeting older Americans by pretending to represent the Social Security Administration. Their methods have become increasingly sophisticated. Some callers use technology that makes it appear as though the call is coming from a government office. Others send convincing emails or text messages designed to create panic. The message usually sounds urgent. "We've detected suspicious activity on your Social Security number. Your benefits are about to be suspended. You must verify your information immediately." Or perhaps the most dangerous of all: "Payment is required today to keep your benefits active." If you ever receive a message like that, stop immediately. The Social Security Administration does not suspend benefits simply because someone refuses to provide personal information over the phone. They do not demand payment through gift cards. They do not ask for cryptocurrency. They do not request wire transfers to protect your Social Security account. These tactics are hallmarks of scams. Whenever you're uncertain, ignore the unsolicited call and contact the Social Security Administration directly using the official contact information listed on ssa.gov. Taking a few extra minutes to verify information can save you from becoming the victim of identity theft or financial fraud. Now, let's come back to the reason many of you clicked on this video in the first place: the letter. Every year, millions of Americans receive official notices from the Social Security Administration. Some explain annual benefit adjustments. Others confirm cost of living increases. Some include Medicare premium information. Others provide updated estimates for future retirement benefits. This year's notices have attracted more attention because they arrive during the completion of the decades-long full retirement age transition, combined with the usual annual updates. That combination has created plenty of online speculation. But remember this: receiving a letter doesn't automatically mean something is wrong. In fact, for most people, it's simply an updated summary of their benefits. Still, don't make the mistake of setting it aside unopened. Inside, you'll often find information specific to your own record, details that no YouTube video, article, or social media post can accurately predict. If your notice hasn't arrived yet, don't worry. There's another way to access the same information without waiting for the mail. Creating a personal My Social Security account allows you to view many of your benefit details online. From there, you can check your earnings history, review estimated retirement benefits at different claiming ages, confirm your full retirement age, and access important notices electronically. It's one of the most useful tools available for anyone planning retirement because the information comes directly from your own Social Security record. Before we move on, let me ask you something. When was the last time you actually looked at your Social Security earnings history? Many people assume it's accurate without ever checking. But mistakes can happen. Missing wages, reporting errors, or incomplete employment records can affect future benefit calculations if they're never corrected. Taking a few minutes to review your record now could prevent much larger problems later. And while you're checking those records, don't stop with Social Security. Think about your entire retirement picture: your monthly expenses, your healthcare costs, your savings, your pensions, if you have one, your retirement accounts, the age at which you plan to stop working. All of these pieces work together. Social Security isn't designed to replace your entire income. It's one important part of a much larger financial plan. That's why understanding these updates isn't just about knowing what changed in 2026. It's about making informed decisions that could affect your financial security for decades. Now that we've covered the annual changes, the Medicare adjustments, the tax considerations, scam awareness, and the purpose of the Social Security letter, it's time to answer the question that matters most. What should someone born before 1961 actually do next? Let's walk through the practical steps, and then we'll discuss one of the biggest retirement decisions you'll ever make: choosing the right time to claim your Social Security benefits.